The equity market had a very nice month. Year to date, and that's through today, I just pulled that up as I was doing this. Year to date, communication services, so that would include Meta, which had a huge move on its quarter, and innovation-based strategies, pure play innovation, disruptive innovation strategies, had an even better month. On the downside, and these were actual negatives, were some defensive sectors like utilities and healthcare down 0.6, although I'll say the genomics part of healthcare. And then energy was down, and part of that was a rebalancing away from energy, which had a spectacular move last year. It was up more than 60% in the equity market. It was the only sector finally that was up for the year. But what is surprising about the 3.8% decline in the energy index is that there are expectations that now that China is off of zero COVID, it will cause a boom in demand for energy. We don't think that's going to be the case. China has been building inventories because it's getting a great deal. It's getting Russian oil for a 40% discount to the market price. So there's an incentive to build inventories. And we think India is doing the same thing. So we don't think a big increase in demand from China based on the return from COVID is going to drive the energy price up as much as many others think. And in fact, the price has been falling in recent days. We're moving towards that $70 mark. The fixed income market is leading the Fed. That usually happens. We have the 10-year Treasury yield, which peaked last October, is down to 3.5%. So it, in October, started to see something, and it probably was disappointing holiday sales, that suggested that the Fed would change its tune at some point. It also saw commodity prices coming down, which were pretty obvious to see. So the bond market leading the Fed, spreads coming down is associated with a risk-on market. So the difference between junk bond yields, so higher risk company debt. On the commodity front, we see commodity prices down 13%, and it is down year over year also. Oil is down 43% from its peak, which was nearly a year ago, down to 73.5 now, and it's down 18% on a year-over-year basis. This is what's going to get into the indexes. The gold price, which has been supported, we think, by Chinese central bank buying, is still down 10% from its peak. Its peak was way back in August of 2020, but it is up 3% on a year-over-year basis. When it comes to crypto, Bitcoin had a spectacular start to the year, up 39%. It's more aligned with innovation strategies performance, and so up 39%, but it is down 39% on a year-over-year basis, as many other assets are down on a year-over-year basis still because of what happened with monetary policy last year. So we're in a risk-on market, and nothing goes straight up, and we don't want it to. We want orderly markets, but it sure is nice to be on the other side when history is told will be a mistake on the part of the Fed. This inflation was transitory, and we do believe that interest rates will start coming down toward the end of this year. I mentioned retail sales down, inventories, they ballooned. There were a few positive surprises on the economic front, autos being one of them. Auto sales jumped from 13.3 million units in December at an annual rate in the U.S. to 15.7. That's a huge increase. That'll be a good retail sales number for January. Big increase. Again, the auto sales were punk at the end of last year, and there are all kinds of reasons. Some companies like Ford are still talking about chip shortages. We think those are diminishing quite significantly. We think the underlying demand for gas-powered automobiles is slowing dramatically as the consumer preference shifts to electric vehicles, and that's clearly happening. Last year, electric vehicle sales were up 69%, and gas-powered sales were down 7%. So big shift here, and I think the auto companies were caught flat-footed. They did not increased discounts to move inventory like other retailers did. Sales were very disappointing. And so I think the discounting started in earnest. So that's good for inflation. So you have a big unit increase because prices are going down. This is, again, flying in the face of the Phillips curve. And I do believe that inflation coming down, which was also a message from the University of Michigan Sentiment Index, that inflation coming down makes consumers feel better. The unemployment rate dropped to 3.4%, a level we have not seen since 1969. And weekly hours were shocking. That rarely happens. But what it will mean if you combine that with average hourly earnings, which were well controlled, that puts the year-over-year wage inflation at 4.4%, which is still less than the CPI inflation, so no wage push inflation there. Income boomed, especially when we incorporate the revisions to previous months. It doesn't square with what we're seeing out there elsewhere. We're seeing the challenger job layoff rate up 400% plus. We are hearing, the headlines are screaming, layoffs. Listening to earnings reports over these last few weeks, one layoff announced after another, or hiring freezes at best. We're seeing the banks take reserves for bad debt. Big increases, like billions dollar increases. Just in the last few days, we saw reports from Amazon and Alphabet, Meta, Apple, Microsoft, and all of them were showing serious weakness. And, advertising is one of the most discretionary of expenses. That actually started weakening dramatically nearly a year ago. We were in a recession last year, and sure, we've gotten a bit of a reprieve, but if you look at what happened in the fourth quarter, the GDP statistics, we did get those the preliminaries. Inventory accumulation accelerated in the fourth quarter. And we thought that retailers were discounting so heavily because they were trying to clear shelves. If you look at the retail sales reports, consumption looked terrible. Now, services bolstered consumption in the GDP reports, but goods consumption was very weak. So what we're seeing from this employment report does not square with reality. There's a lot of disruption taking place to them. So Amazon, I was very surprised at how weak its sales were. Even its AWS was the strongest part of the company growing, is dropping. The guidance for this quarter is down to 15% as Google and Microsoft compete more aggressively. But Amazon also has another issue, and that is social commerce. So now that more and more consumers are buying in-app. They're buying on Instagram, which is supported by Shopify. They're buying on Facebook. They're buying on TikTok. That's become a bit of a problem for Amazon. If we're talking about Google and Alphabet, ChatGPT, at our brainstorm today, we had a number of people saying that their search queries on Google have collapsed. They're now just using ChatGPT. That's a big problem for Google, and its advertising was quite disappointing. And even Microsoft was under a bit of a cloud, not its own cloud service, which is slowing down but is still growing in the 30% range. But its base business was slowing. And we're seeing a lot of tech layoffs, which will hit these companies. So a lot of disruption to the former disruptors. Although Meta, of course, came out this week with a big surprise. Its numbers didn't look good. They were negative on a year-over-year basis. But Mark Zuckerberg described some new products, so activating monetization on WhatsApp so that businesses can message consumers. That seems to be gaining a lot of traction, which is great. And the other thing that Mark Zuckerberg focused on was efficiency. He probably used the word efficiency 10 times. In conjunction with artificial intelligence, AI is taking off. ChatGPT captured the consumer's imagination, but has also activated businesses' imagination. How can we use AI to control our costs, to increase productivity, the massive productivity gains that we expect. And that's probably one of the biggest promises of AI. Many people are looking for the killer app, sort of like the social apps around the internet. But the killer app is productivity increases, which could mean, in the short term, more layoffs as companies start to operate more efficiency by harnessing artificial intelligence and their proprietary data pools.